Hello, it's Bob. Still in this lecture, we were going to continue on Chapter 12, the liquidation of a partnership. So that's the close of a partnership. The partnership is closing up. We're going to liquefy the partnership. Obviously, this transaction is not going to happen every day, but the process is really good to understand the trial balance and journal entries in the trial balance. So this is a good process to go through, even though it's not a day-to-day transaction that's going to happen all the time. Liquidation of a partnership. A partnership dissolution requires 3 steps following the sale of a non-cash asset and the recording of a gain or loss on liquidation. So first, we got the gain or loss on liquidation is allocated to partner using their income loss ratio. Liabilities are paid off. Any remaining cash is distributed to the partners based on their capital accounts. So if we think of the trial balance, we need to first say what assets do we have. We need to take any non-cash assets and make them cash assets. So we want to make all the assets cash. So if we have property, plant, and equipment, for example, we don't know what the fair market value is, and we can't close the company out and distribute that as easily unless we sell that property, plant, and equipment for cash. Once we have the cash, we may have a gain or a loss on that sale that we'll then have to allocate to the partners in accordance to their profit and loss agreement when we sell our property, plant, and equipment and other assets. And then we're going to have to pay off our liabilities because we have to pay the liabilities before we pay off the partners. And then at the end of this process, we'll be left with just cash and the capital accounts that we owe to the owners. And then we can just distribute that cash in accordance to the amounts in the capital account. So no capital deficiency. No capital deficiency means that all partners have a zero or credit balance in their capital account. So it could be a situation where a capital account for a partner is negative, meaning it has a debit balance. And that would mean that the partner basically owes the partnership money. And so hopefully that's not the case, and that will make the closing process easier. So Zain, Perez, and Rashid agreed to dissolve their partnership. The only outstanding liability is an accounts payable of $20,000 prior to dissolution of the partnership. Has the following balance sheet. So this is a pretty basic balance sheet. Let's just take a look at the debits and credits here so we can see this. We got $178,000 as a debit to cash, $40,000 for the land, minus the liability here of $20,000. So we have the 198 is the assets minus the liabilities. That should equal what's owed to the owner, meaning the 3 partners here. So 198. We have the 70,000 plus the 66,000 plus the 62,000, the 198. So we can't just pay out that 198 in accordance until we do a few things. First, we want to sell this land because that land we may not receive 40,000 for it. We may receive more. We may receive less. We gotta sell that out. We gotta recognize the gain. We have to allocate that gain to the partners in accordance with their income ratios. Then we need to pay off the $20,000, hopefully before we pay off the partners, because we don't want to be in a situation where we pay off the partner before we pay off the liability, and then we don't have the money to pay off the liability. So ideally, we want to sell the land, want to make sure we get as much as we can for any assets. We want to recognize that gain or loss on the sale. Then we pay the liability. Then we pay off the capital accounts. So if we have the boards began the dissolution process by selling the land for $46,000. So we sold the land for $46,000. So let's take a look about that. Is cash affected in that journal entry? Yes. We got $46,000. Cash is a debit balance. We're going to make cash go up by doing the same thing to it, which in this case would be another debit. So we're going to debit cash for the $46,000. Then we're going to credit land because we sold the land. Land is on the books for $40,000, we just saw in the prior slide. Therefore, we need to make it go down to 0. Land is an asset. Assets have debit balance. In order to make it go down, we're going to do the opposite thing to it, which in this case would be a credit of $40,000. Now we have a debit of $46,000, a credit of $40,000. We need another credit of $6,000 in order for the debits to equal the credits. We sold the land for more than it's on our books for. Therefore, we have a gain. A gain, if it was a sale in the normal process, would be on the income statement. So a gain would be similar to income, meaning it's a credit. It would increase the income statement net income. Then, of course, that gain, if we were to close out the income statement, we would close the income statement to the capital accounts. So that gain then needs to be allocated to the capital accountants in accordance with the profit sharing agreement, which is an even split. So that gain, now we're going to debit the gain to reduce it to 0, and we're going to allocate it to the partners evenly, 2, 2, and 2. So we reduce the gain, we increase the amount owed to each of the partners by the gain of the 6,000. So now we can pay out 2,000 more because we sold the property for more than it was on the books for. So then now what the next step, of course, is to pay off the liability. So we got to pay off the liability before we pay off the owners. So now the land is off the books, and we're going to pay the liabilities. What are we going to pay it with? Cash. Cash is a debit balance. We're going to make it go down by doing the opposite thing to it, which in this case would be a credit. Therefore, we have to debit the payable. We know the payable's on the books for $20,000. Payable is a liability. Liabilities have credit balances. If we debit the payable, that will make it go down, because we're doing the opposite thing to it as what it is, which is what we want to do. That will take the payable down to 0. After step 2, we have the following capital balances. Now, all we have on the books is cash of $204 and the capital balances of $72,000 plus $68,000 plus the $64,000. So, which is the 204. So the credits equal the debits. And now it's just simply, we're going to remove the cash. Cash has a debit balance on this side. We are going to credit cash to take it off the books, because we're going to do the opposite thing to it to make it go down. Credit cash by the 204. The capital accounts all have credit balances, and we are then going to debit them to take them off the books for the amount that is in the capital accounts. And once we do that, that will clear off the entire trial balance. Will be back down to 0. So capital deficiency. Capital deficiency means that at least one partner has a debit balance in his or her capital account at the point of final cash distribution. This can arise from liquidation losses, excess withdrawals before liquidation, or recurring losses in prior periods. So for whatever reason, one of the partners has a negative capital account, basically a capital account with a debit balance, which means that the partner owes the partnership in essence. So a partner with a capital deficiency must, if possible, cover the deficit by paying cash to the partnership. So hopefully if that happens, the partner goes, okay, I'm going to pay cash to the partnership, and then you can allocate that off to the partners in accordance to their capital account. That may not happen, because when we're liquidating, things may not go as smoothly as we hope, but that's the hope. So Zain, Perez, and Rashid agreed to dissolve their partnership. Prior to the final distribution of the cash, Zain has a capital balance of 19, Perez 8, and Rashid has a negative 3. So Rashid owes the partnership the $3,000 and is able to pay. So hopefully Rashid goes, yes, I over-withdrew and we're dissolving the partnership, but it's my responsibility to put that $3,000 back in, and then you distribute it as it should be. If that happens, then Rashid will give the $3,000 to the partnership. Cash has a debit balance. We're going to make it go up by doing the same thing to it, which in this case would be another debit. And then we would credit the capital account, because the capital account has a debit balance in it, meaning it's overdue, because capital accounts should have a credit balance. This one has a debit. We're going to make it go to 0 by crediting it, therefore, to make it go to 0, taking Rashid off the books there. Now, this type of activity could result if we started paying off a partner in a dissolution before we sold the assets, for example. So if we started paying off the partners and then we didn't get $40,000 for the land, we only got $10,000. Well, then that loss on the sale of the land that we didn't see coming could result in this type of thing happening. So in a dissolution process, we really want to sell all the assets first, then pay the liabilities off, and then do the allocation. Once that happens, then we can pay the remaining partners in accordance to their capital accounts. So then we're going to pay off the remaining cash. That's just what's on the books after this transaction. So it's on the books at 24. We're going to credit it, make it go to 0. And what's on the books for these capital accounts on the trial balance is 19 and 8. And we can just pay those off respectively, making the entire trial balance go to 0. So let's use, if the partner cannot pay. Now, there could be a situation we're trying to close the partnership. Rashid owes $3,000. Rashid's not going to pay it, so we're just going to close it anyway. And if that happens, then the Zane and Perez are of course going to have to eat that 3,000 in accordance to their profit sharing agreement, which is 50-50 in this case. So that would mean that we need to make Rashid's account go to 0. So once again, it has a debit balance because it's overdrawn. We need to make it go to 0, so we're going to do the opposite thing to it, which would be a credit of the 3,000. And then the capital accounts for Zane and Perez are going to have to go down. So capital balances have a credit balance. We need to debit this in order to make this go to 0. We're going to debit evenly the 1.5 and the 1.5 to make Zane and Perez capital accounts go down. Then we can just pay off just like we would normally. Cash has 24,000 on the books. We're going to make it go down to 0 because we're going to pay it out. So we will credit the cash, making it go down, and then we'll debit the capital accounts, making them go down to 0 by what's in the two remaining capital accounts respectively.